Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. All the comments, the support, the subscribers, I greatly appreciate it. This week we are going to dive into Allstate, the insurance giant. Had a lot of comments on the channel. Do the stock. If you guys are not paying attention to the comments down below, definitely check it out. There's a lot of value hunters pinging me about great stocks out there, and this is going to be a fantastic one. Let's check it out. Here we go. Okay, let's dive into Allstate. Before we do that, let's cover the 5 key attributes that we use in evaluating all of our investments. And those would be top-line revenue growth. You got to have it. Earnings growth, strong free cash flow, low debt, and a well-priced stock. Those 5 key attributes we use as the starting point for any financial analysis, right? This channel is dedicated to cash flow investors, rational, value-hungry, long-term investors who don't speculate, who don't buy because the stock price has passed some sort of magic line and suddenly it's a buy. No, we're buying hard money cash flowing assets that we hold for a long time, and that cash flow compounds over many, many years and yields us a surprisingly large return. And we're going to take a look at Allstate right now. Here we go. Okay, so let's dive into Allstate. The first thing we're going to do is we're going to take a look at revenue. So revenue went from $33 billion in 2012 to $45 billion in 2020. That's a solid growth rate of 4% annualized over this period of time, which definitely checks our box for revenue growth. It's not huge, but it definitely checks the box, and that's one of the hallmarks that we want to see. Now, I would normally do EBITDA growth, but because it's an insurance company, they don't report EBITDA. It's not something we can get, so we're going to check the box by saying it is profitable, and we're going to move on to look at debt and leverage. So next thing we want to do is we want to look at debt. Here, I'm taking long-term debt, I'm taking the current portion of long-term debt, and I'm going to include the preferred equity note. Preferred equity in here, it's on the balance sheet in the equity section. The reason I'm including it as debt is that a company can choose to lever itself up with debt or more stock. In this case, they said, well, I don't want debt and I don't want stock. I'm going to do a hybrid. It's going to be preferred equity. Preferred equity is just basically another layer of debt that's in front of the common stock. So we're going to count it as debt. Even though it's called equity, technically it is a facet of equity, but us as common stockholders, that's what we're buying. Anybody in front of us in the bankruptcy court, in my opinion, is a debt obligation, and I want to make sure I capture them in the debt number, because if the company goes bankrupt, the judge is going to pay out the assets of the company in the order of the capital structure, and preferred equity sits in front of equity, so I'm including it as debt. And it went from $6 billion to $10.3 billion in that time, while revenue went from $3 billion to $4.4. So definitely growing almost double, while revenue has not even doubled at all. No net cash on the balance sheet, so I'm not giving it any credit for excess cash. Any cash they have is in their float. I'll cover that in a while, so I'm giving it 0. So total debt is basically just this column, easy. Now, leverage ratio. Here, what I'm using is a cash flow from operations figure. Again, we can't look at EBITDA, so I'm not picking that up. I'm going to pick cash flow from operations because I know it's hard cash that they made from running their business. And I'm going to compare the outstanding debt to that number. And you can see when I take net debt, which is here, which is essentially this column because there's no cash, divided by the CFO, which we'll cover in a second, I get 2 times to 2 times. Basically flat. So they're doing a very good job managing their capital structure with the cash flow they have, which you would expect an insurance company to do, right? They are managing risk. They are matching duration, as they typically call it in insurance business, where they're pairing liabilities with asset duration. So here they are 2x, pretty close to that every single time. That checks the box on our leverage ratio, right? We want to see low debt, less than 3 times. I use profit typically, but in this case, we're going to substitute for cash flow. All right, speaking of cash flow, let's go to my favorite statement and check it out. All right, cash flow statement, where the rubber meets the road. Let's check out cash flow from operations 2012 to 2020, $3 billion to $5.5 billion. That's a solid increase of 8% annually over time, which is good. It's both directionally good for we had revenue as a check, so it's moving in line with revenue, actually a little faster than revenue. So I'm hoping that's margin creep that we're seeing as they scale. But they went from $3 billion to $5.5 billion. It looks like recently they've really had a run up in profitability. Here, they sit in this $3 to $4 billion range, but then here they jump up to 5.5. So it's nice to see good continued growth. CapEx, not much here, which you'd expect. They're an insurance company. It's an asset-light business. They are not buying property, plant, equipment, big office buildings, big machinery, factory lines. They don't have any of that. So a lot of this is going to pass right through to the cash flow of equity, which is what we want to see. The next thing we're going to look at is debt when we're calculating free cash flow to equity, CFO CapEx debt payments. Positive numbers are inflow of debt, like I borrowed money from my house, I took out a home equity line of credit, something like that. Negative is payment, so I'm paying out cash for refinancing of debt or paying down principal. I add these up and I get free cash flow to equity. This is what a business is valued on. This is the actual cash that they can dividend out. They can buy back shares with it. They can go make an acquisition with this cash. This is truly the value of a business. And you can see the debt payments line up with what we saw earlier, that debt to cash flow hasn't really changed. You have some outflows, some inflows, but all in all, these numbers aren't that scary, and they're not that big when you relative to how much cash flow they make. So they made $5.5 billion. They had to put only $300 million back in the business, so that leaves them about $5 billion. They borrowed a little extra, so at the end of the year, they had $6.3 billion just piled in the bank. They're like, okay, what do we do with it? Let's see. Shares. One of the things they're doing here is they are buying back their own shares. 482 million, 455 million, 419 million, 300. You get the idea. All the way down to 304. So they're chewing up their own shares on an average clip of about 5.5% every year, which is amazing. And that is a tax-free dividend to the shareholders, right? You don't have to do anything. They are reaching into the market, buying them, canceling the shares, and your percentage ownership of this company goes up over time without you having to do anything. That is a very cool thing. If I keep going, I show you cash flow per share, just taking free cash flow divided by shares, pretty big number. You need something to compare it to relatively because it's a per share basis. So I take per share price, $106 recently, $20, $21 of free cash flow. That is a 20% yield. Look at that sucker. How often have I done a stock in this channel that's thrown off 20% cash flow? That is impressive. Kudos to the channel for digging this up. I really appreciate it, and it took me a little while to get to it. I believe this is the third rendition of this sheet that I've gone through to try to get these numbers right. But this is, within spitting distance. I think I'm close. And when I'm adding the little extra debt that they borrowed in 2020, it kind of bumps this number up over what might be like a stabilized rate of, say, mid-teens, basically, in this most recent 2020 year. If you recall here, $1.2 billion they borrowed. That's kind of like a high water mark. That's boosting this number, which of course is boosting this yield right here. So I think they're in this 15% free cash flow yield, which in this market with interest rates at 2% with a 10-year treasury, that's fantastic. We don't see that very much in this channel, so I'm sticking on this point because it's actually remarkable. I was shocked when I saw it. And then when I look at free cash flow growth over this period of time, remember we saw revenue was growing at 4%, free cash flow of operations was growing at 8%, and now free cash flow, not per share, but the total free cash flow to equity is growing on average 10% annually over that period of time. Really, really solid. So I like the cash flow. That's definitely checking the box. It's both growing and strong. Good for them. That's fantastic news. Okay, the normal thing we would do here is forecast the future price, right? We've got the free cash flow to equity, and we're going to forecast for it. But we have to pause here for a minute because this is an insurance company, and we have to twist things up slightly. What makes insurance companies special? Why has Buffett been buying them for decades, right? It's the float. The float is you pay your insurance provider sometimes 6 months, sometimes a year, sometimes multiple years in advance of payment. Think of a life insurance contract you might buy, make payment for 20, 30 years, and then they might have to pay out. But that money you're giving them is the float. You give them the money, and they're not obligated to make delivery of payment until you wreck your car, until your house burns down, until you die. So there's a float. There's a period of time they get to use that money for their own investment purposes before having to make good on your contract. It's called the investment float, and you can find that on the balance sheet as a portfolio, an investment portfolio. In Berkshire Hathaway's case, it's predominantly equity. Here, it's actually predominantly fixed income investments, and I want to go through it because it's going to be a critical piece to understanding the free cash flow. We're going to have to adjust that, and then we're going to have to forecast two components, both the free cash flow and the portfolio. Here we go. So you can get this bond breakdown on page 196 of their most recent 10K. Highly recommend you read it, by the way. So here's the breakdown of investments that they have listed in the balance sheet. Fixed income, that is a bond investment that they have, and they have $66 billion in bonds on the balance sheet. Equity securities, $4.7 billion. So significantly less than we would normally have liked. Mortgage loans, again, debt instrument. Limited partnership, that's private equity. They've got $7.6 billion in private equity. Short-term notes, so short-term debt, just even short-term, and then another bucket. Total investment portfolio, $94 billion. They almost have $100 billion of jack that they have as float investing to try and generate a little extra return while they wait to make payment, if they have to make payment on that obligation. Now, this number here, this is the capital gain and the income that this portfolio generated in 2020. So what's happening is they've got an investment portfolio, fixed income. Fixed income right now is paying maybe 2 to 3%, something like that. So they're getting coupons from those bonds. And then if something should rise in price, so like the equity portfolio or the private equity business, if those have gains, then they have a gain that they get. And there's two pieces to that. It's listed in the income statement. I'll show you in a second. I add those up, and for the year, they made $4.2 billion on this portfolio. Now, what I want to do is we need an investment rate of return that we can assume this portfolio will generate over time in order to forecast. And so what I've done is I have taken these numbers, given you a percentage. This is their portfolio mix, right? There's 70% long-term bonds. Well, it's really short-term, long-term / bonds. But heavy fixed income, right? Fixed income. And then I've gone into the current financial market and pulled current rates for these types of investments. And I'm using, like, for the bonds, I use the Vanguard short-term and long-term bond index ETFs to pull current yields, plug the current yield and kind of split the difference. And I get 2.7%. Walked on down. The private equity is an assumption on my part. That's kind of their target rate. Equity, S&P, and I get a blended average return 4.4% annual, both a gain and a cash flow that they're going to get from this portfolio. And I can smell check this number by taking 4.4% times $94 billion, gets me $4.15 billion of assumed 2020 gain and cash flow. Well, they actually made 4.2 in their financial statements. So these are really close. That smell checks. I like that. And that says that I can take this yield and forecast it forward depending upon what I think interest rates might do. But that yield is a decent benchmarker for what they're currently yielding on their portfolio. All right, so here we are, page 160 of the current annual report, 2020 fiscal year, net interest income, $2.8 billion, realized capital gain losses, $1.3 billion. I'm adding those two up to get that total interest and gain return that I said earlier. And you'll notice that total revenue for the company includes these two. So you have to be careful when you're talking about revenue from the business or total revenue, or earnings from the business versus total earnings. I pulled this number for our total revenue, which was growing, but we're gonna separate cash flow out here for these two numbers, because what we want before we start forecasting, we want to know two things. One, investment portfolio. We just did that. What's the return on that? We just did that. Second, what's the cash flow of the underlying business? Forget the float for a second. We know that's making 4.5%. What's the rest of the business doing, and what's that forecast? And what we're going to do is we're going to have to adjust free cash flow from operations for these numbers. I'll show you exactly how to do that. Okay, the next thing we need to do is we need to adjust the free cash flow from operations. Now, behind me is the free cash flow from operation that we just covered earlier, right? It's coming directly from the cash flow statement, top third free cash flow from operation, booyah, $3 billion to $5.5 billion. This column, this is the interest income that they receive. Remember, I showed you the income statement. There were two bits. There was a capital gain piece and there was a realized investment income. That realized investment income flows down to the net income. Cash flow statement picks up on net income and flows down to operating cash flow. So this number is in here. And if we're going to separate these two and forecast two different bits, the portfolio and the core operation, we need to separate those two. So I'm going to take free cash flow from operation and I'm going to remove the investment income out of it, and I'm going to get a adjusted free cash flow to equity, which is kind of flat in here, a little negative, a little positive, but then stands quickly up and becomes strongly positive, $2.6 billion, which is a great number. All in all, the growth rate's pretty decent. In here, it gets a little dicey, I grant you that. But this section here, that's strongly positive, and that's an average of 50% annually. It's a pretty decent number to go from essentially, I don't know what that's, zero-ish to 2.6 billion. Strong number. It responds well to the cash flow from operation growth that we're seeing. So I think that means that their core business is starting to gain speed, starting to generate cash flow on top of what the portfolio generates. Okay, now we need to forecast forward both the free cash flow from operations and the investment portfolio. So here we go. I'm going to pick up adjusted cash flow from operations and let's forecast it. Okay, now we need to forecast our adjusted cash flow from operations figure. So that's what this is. This is 2020's adjusted cash flow from operations minus CapEx, growing at a 7% rate. 7%, why? Because both the free cash flow that we calculated, that free cash flow to equity, that was a strong double-digit growth rate, and adjusted free cash flow was also a strong double-digit growth rate. So I'm going to give this a 7% to be conservative, and I'm even going to drop it down to 5 over time just to be super cautious, because insurance businesses do have large losses, so I want to be careful. And by growth rate, I'm definitely not increasing the growth rate over time. I'm decreasing it because certainty of future declines, so I want to bring this down. Anyways, $2.5 billion to $4 billion of adjusted free cash flow to equity, adjusted free cash flow operation. I'm going to give that an 8% yield, and that produces a $50 billion market cap on just the core insurance business. Now let's go get a market cap for the portfolio and we'll combine the two. Behind me is the portfolio and the growth rate. So what I'm doing is I'm picking up the portfolio on the balance sheet in 2020, which is carried at market value. And this 4.4% yield is the yield that we arrived at by looking at the breakdown of their assets in the portfolio, getting current yields for those assets, doing a weighted average, and I get 4.4%, and I held it flat. I'm not making a big call on interest rates. I want to see if this business can support itself with this assumption, and then we'll see what the return is, and we'll judge that return relative to the risk of this interest rate movement. $98 billion estimated next year. This is total return, by the way, so it's both capital gain and interest income reinvested to grow the portfolio. And what I get is $145 billion of market value out 10 years for this float, for this investment portfolio. All right, now we have the two pieces to our forecast. We forecasted the core business through adjusted cash flow from operations, and we forecast the investment portfolio over time using current market yields. Now we're going to combine the two to get a sum of parts valuation. Behind me is the 2030 market cap for the adjusted cash flow from operations less CapEx, $49 billion valuation, and right below it, $145 billion for the investment portfolio. Clicking along at 4.5% a year for a decade, I combine the two and I get just shy of $200 billion of long-term equity value for Allstate. Shares outstanding, 300 million, right? They've been chewing those shares up over the last decade, buying 5% every year. So there's a lot fewer shares outstanding for such a monster equity portfolio. I divide the two and I get $641 per share as a long-term forecasted stock price. Okay, now that we have rationally walked through how we want to value the business, we have our mind around what we're willing to pay for it because we know its long-term value is or we think its long-term value is $641 per share. Let's go on the market and see what it's trading for. Okay, behind me is the IRR for an Allstate investment. It's currently trading at around $177 per share. I can buy it now, and I'm going to get a cash flow stream over time. That's the core business operations, our adjusted free cash flow from operations, less CapEx per share gives me this stream of cash flow. I buy now, I sell in the future at $640 per share. That's both the core business and it's the equity portfolio, the investment portfolio, because it's mostly bonds. $640 a share combined gets me a stream of cash flow. When I IRR this, that is a 20% annualized return through here. That is fantastic. It also means you're going to make roughly 4 times your money by holding this stock for a decade. That's amazing. Let's recap our 5 key attributes here. Top line revenue growth is growing. Earnings are profitable. Cash flow is profitable and strong. Low debt, yes. And well priced, absolutely it is. We're going to give this business a good. Why? 20% IRR is very strong. I've done over 50 videos. Very few of them have shown a return of 20% or higher. It's a very good return. Why is it so cheap? Possibly it's the investment portfolio it owns. It is predominantly in fixed income bonds, which has an interest rate risk component to it. As interest rates rise, bond assets fall in value. So I think the market is saying, hey, rates are rising. That equity portfolio could fall in value. Okay, but it's still yielding a coupon. And if rates don't rise much more, then that portfolio will kick out that cash and that 20% will be realized. So it's a strong top line, so it's a strong performer. If rates rise, the bond portfolio will come down in value. This number will come down below 20%, but maybe it's 10%. It's still a strong return, and I think it's worth taking a look at it. If the price of the stock were to move a little bit, here it's at $177 a share, it's at 20% return. Here's a little distribution. If the stock price should rise, it's still a double-digit return stock. If it falls for some reason, it becomes, in my opinion, even more of a buy. But I do like this stock. I gave it a good rating. It matches all the 5 key attributes. So thank you very much for watching Allstate and Rational Investing. Please comment below and let me know what you think. Let me know what you want to see next. And don't forget to hit the subscribe button. Thank you very much. Bye-bye.